Good morning. Today we're going to talk about an area that you probably find very, very interesting. Many times we have clients that come in and they have questions regarding life insurance, both term and permanent. So today what we're going to try to accomplish is to tackle term insurance. Now most of you probably think that you feel comfortable, but I hopefully will answer a few questions and teach you a few things about term insurance. First, we're going to start off, as I mentioned, with term. So you basically have two types of term insurance. Okay, you have term insurance that's level, and you have decreasing. So you have decreasing and level insurance. Both of them have periods of time for which they run. Example, decreasing insurance is often used as something we call mortgage insurance, to pay the mortgage off in the event of a premature death. So decreasing insurance usually is a 10 or a 15 or a 30-year decreasing insurance. So basically what happens is that if you buy insurance to pay off the mortgage, when you sign up for or refinance your mortgage or you buy a new home, you'll have someone that may contact you and say, do you want mortgage insurance? Well, people get that term mixed up because there's two types. There's the type where the bank requires you to have mortgage insurance. That doesn't pay your home off in the event of your death for your family. That's because you don't have 20% equity in your home when you purchase it. Life insurance is just mortgage insurance that's decreasing. So what would happen in this case, if you had a 30-year mortgage, you'd buy 30 years of decreasing insurance. It would start out at the full value of the mortgage and then decrease down to zero at the end of 30 years. Level term is basically 1 year, 5 year, 10 year, 15 year, 20, 30, all kinds of things, and now they have what they call a lifetime term. Okay? Now we'll talk a little bit about the differences here. Decreasing is generally to cover a loan of some kind, a mortgage. I've had businesses that have borrowed money. They want to pay their home or want to pay that loan off in the event of a premature death of one of the partners passing away. They buy decreasing insurance to pay that loan off. A lot of people are using level insurance for those reasons also now. Term insurance, based on the new rates for mortality, are extremely low right now. And so you can get level term insurance for 1 year, what's called 1 year renewable. So every year it renews and the premium goes up a little bit every year. You have 5-year level term where the premium is level for 5 years. And then you have 10-year level term, level 10 years. Now, 10-year level term is one of the more popular terms because young people, a person age 30 or 40, can buy $500,000, $1 million of term for under $50 a month. Okay? So they're looking at being able to buy substantial amounts of insurance for a very low premium for a temporary period of time. Now remember, when those 5 years, 10 years, 15, 20, or 30 years come to fruition, okay, when they're done, that premium goes up so dramatically, you need to make sure that when you talk to your insurance agent, you ask him what that premium is going to be at the end of the 10, the 15, the 20, or the 30 years. I think you'll be quite surprised. It will more than be 5 times or higher what the premium is that you were paying prior to that time. Now, another thing to remind people of is if you're in good health, if you buy a 10-year term or you buy a 15-year decreasing or 30-year decreasing, you basically can convert that. The kind of policy that you would convert it to would be a permanent. We'll talk about that in another session, the advantages of permanent and the differences between those and how to use those accounts. So again, term insurance comes in those the cost is very low. Check with your tax and financial advisor. Talk to your insurance agent. He or she'll be able to help you. But the amount that you need, you simply take here. You take, if you have an $80,000 a year income, always the question, how much am I going to need? You take your income and you divide that by, let's say, 6% or 5%. And what you're going to come up with is actually the amount of insurance that you're going to need to generate $80,000. So if I take $80,000 a year as my salary, I divide that by 6%, and basically right now I'm going to need $1.3 million to provide $80,000 a year net to my family. Now, if you had to determine the exact amount needed of insurance for your family, you probably need to do a budget or a spending analysis so that you can determine that if you passed away, how much would your family need to do the things that you need and want to do for them if you were taken out of the picture. Anyway, that'll give you a little bit of an idea on the difference between the two types of insurance, level and decreasing, and then how much to determine how much insurance you actually need. Thank you very much. Hope you enjoyed this.